Hey everyone, thanks so much for tuning in to today's Options Trading Masterclass. I'm very excited to present you this today, and I'm sure that you can learn a lot. My first recommendation before we start is that you take some notes. By taking notes, your learning experience will be much better. So let's get started. First off, I have to show you this legal disclaimer. Ideally, you should read it now. I give you a few seconds to do that. Otherwise, you could also pause the video. But basically, it says that I'm not a financial advisor. I don't offer any investment advice. You should do your own due diligence. You should do your own research before risking any of your money. And everything that I'm going to present is for educational purposes only. Stock and options trading, or trading in general, has some inherent risk, and potentially you could lose all of your money. And past returns aren't indicative to future returns. So neither my performance or someone else's performance can show you how your performance can be in the future. So with that out of the way, this is a brief outline of today's presentation. First off, I'll start by presenting the goal of this masterclass. Then I want to tell you who I am. After that, I'll give you an introduction to options and tell you why options are potentially better than stocks or other investment vehicles. Afterwards, we will get into some options basics and some technical stuff. I'll present the different types of options, how they are set up, for example, strike prices, expiration, buying versus selling options. We'll also get to some options chains. And at the end of this presentation, I will give you some examples, and I'll also present some quizzes so that you can learn and apply the knowledge that you learned in this presentation. And shortly before the end, I have a little gift for you, so stick around until then. And last but not least, I want to try to help you develop the right trading mindset, because trading and learning to trade requires the right mindset. If you approach trading with the wrong mindset, you will be disappointed. So throughout the entire presentation, I want to try to teach you what a good beginner mindset is. So first off, what's the goal of this presentation? Just like the name implies, this is an options trading foundation masterclass. So my goal with this presentation is to build a strong foundation so you are ready to learn everything that an options trader needs to know. The foundation, just like for a house, is the most important thing. If something's missing on the foundation, everything can collapse. And this is not only applicable to building houses, but also to trading. If you rush into this and don't build a strong foundation first, you may base your entire options trading systems or strategies on something totally wrong. So hopefully after this masterclass, you will be familiar with all the options basics and have a stable foundation so that you can learn more advanced concepts later on. No prior experience or knowledge is needed for this masterclass. Next up, I want to show you what this masterclass is not supposed to do. These are the top floors of a skyscraper. And if you're taking this foundation masterclass, you probably aren't at these top floors yet. It takes years of preparation, experience, practice, and more to reach these top floors. Hopefully one day you'll be there, but it's not yet. It's not today, not tomorrow, probably not next week or next month, potentially not even next year. Trading is not an easy thing, but it's definitely possible to trade profitably and to earn your money through trading. So potentially trading can replace your job. However, it's not going to be an easy way. You should take your time, build one floor at a time, and sometime you will maybe reach this top floor. However, don't rush it, start by building the foundation. So, who am I? My name is Luis, and I'm your presenter today. I was born in Chicago, and both my parents are German, so I grew up in a German-speaking household. You probably can hear that my English isn't perfect, but I think it's good enough for you to understand me. I lived in Chicago, in London, in Zurich, in Copenhagen, and currently I still live in Denmark. So I've traveled a lot in my life. But how did I get interested in the stock market, you may ask yourself? Well, like most people, I got interested in the stock market because I thought, wow, tons of easy money from anywhere in the world, just from a laptop. That's the dream life. Who wouldn't want to travel the world and make tons of money from only his laptop? So that's how I got interested in the stock market. But quickly I learned that things weren't as easy as I thought. Don't get me wrong, the stock market is a great place. It can potentially replace one's job, and you can definitely earn some good money from it. But it's not easy. I quickly learned that becoming a profitable trader requires a lot of hard work, preparation, and education. And that's why I got into trading education. I began to educate myself. I didn't have a lot of money, so I didn't want to spend tons of money on fancy courses that promise easy money, but that don't actually deliver. So I didn't. I consumed tons of free educational content on the internet. I went from one free site to the next, and to the next. I consumed as much free education as I possibly could. As I said, I didn't have a lot of capital to trade with. Therefore, I couldn't trade in all these big name stocks like Apple, Microsoft, or whatever. That's why I initially got into options trading. Options require much less capital than stocks. But more on that later on. It took me around 2 years to completely understand options, find a profitable system, and start trading. And even after that, even now, I don't stop educating myself. I'm still working on improving and revising my trading and learning from it. One important thing that you have to understand in trading is that you should never stop learning. Education is key to success in trading. Never go out there and risk your hard-earned money without being fully prepared. Before we get into the options trading itself, I just want to say that I won't act the same way as most other shady trading educators. I won't lie to you and tell you there's only one way to make money in the markets. I will tell you the truth, and that's that there are countless other ways to make money than with me. There are countless profitable trading strategies and systems. Options aren't the holy grail of trading. You can definitely make money by trading options. You can definitely also make money by trading something else like stocks or forex. There's more than one way, just like in this picture. With that being said, it's still important that you focus, at least in the beginning, on one of these ways. You shouldn't jump around and only stay on one way for a day or a week or even a month. Find one, commit to it, and actually go through with it the whole way. Otherwise, you won't find success in trading or actually with anything else in life. Life requires commitment, and so does trading. Like I just said, it took me around 2 years to fully understand options and to find a profitable trading system. My goal is to cut this learning curve down. I want to be your trail guide and your mentor. But that's enough about me. Now let us get started with the actual education. So, Why options? Why should you trade options over something else? There are so many other trading products out there. So why options? Why not stocks, ETFs, penny stocks, forex, futures, commodities, or whatever else? Actually, options allow you to participate in all of the just mentioned investment products. Yes, that's right. You can trade options on stocks, on ETFs, on penny stocks, on forex, on futures, on commodities, and on most other assets as well. Furthermore, options offer a few advantages over some of these products. So let's compare options to stocks. First off, how can you make money with stocks? Well, you either buy stocks or you short sell stocks. As most of you know, when buying stocks, the price of the stock has to go up for you to make money. You want to buy the stock at a low price and sell it at a high one. The opposite is the case for short selling stocks, but that's not so important right now. Well, let me tell you how you can make money with options. Options are very versatile. You can buy options, you can sell options, and you can do both at the same time. So actually, you can make money on increases in price, on decreases in price, on range-bound movements, on big moves, on small moves, on moves to specific prices, and much more. Like I just said, to make money with stocks, you either buy or sell them. So either the asset's price goes up or it goes down. So roughly speaking, there's a 50-50% chance of you making money. Maybe you use some fancy indicator and increase your probability of success by a few percent. However, with options, you can choose to trade non-directional strategies. That means that not all options trading strategies require price movement. That actually puts the odds in your favor, so you can actually trade very high probability option strategies. So instead of having a 50-50 shot at it, you can maybe have a 70 or even 80% probability of profit. You will learn how to trade with a high probability of profit later down the road. Another disadvantage of stocks is that they require a lot of capital. Many stocks trade for hundreds of dollars. So if you want to buy a few hundred shares, you already need thousands of dollars to buy or sell them. And this isn't the case for options. Options use something called leverage. Leverage lets small amounts of money control larger amounts of money. But note that leverage can work both in your favor and against you. On the one hand, leverage can increase your returns, but on the other hand, it can also increase your losses. Therefore, it's important to know what you're doing when trading with leverage. But don't worry, if you educate yourself and get some good trading education, you will learn how to trade with leverage without risking too much money at once. Actually, some option strategies allow you to limit your risk. So even if something totally unexpected happens, even if the entire market crashes, some options trading strategies have a limited risk. They can't lose more than a certain amount of money. Nevertheless, stocks still have some advantages over options in other aspects. One example of this is unlimited time. If you buy a stock, you can theoretically hold it forever. This isn't the case with options. Options have an expiration date, and after that, the option is gone. You can't hold it any longer. But more on that in a few minutes. Another disadvantage of options is that, generally speaking, stocks are a little more liquid than most options. However, if you focus on liquid options, this won't be a problem. Now I will present the different options that exist. Actually, there only exist two options. You can either trade call options or put options. Before I tell you how these two different options work, I just want to say how options are traded generally. Options are derivatives. That means that the options price is partly based on an underlying asset. This underlying asset can be a stock, an ETF, or something else. So you trade an option on a stock. For example, you can trade an option on Apple. Call options gives you the right to buy the underlying asset at a certain price. Put options, on the other hand, give you the right to sell the underlying asset at a certain price. It is important to understand that these options give you the right to either buy or sell the underlying asset. You don't have the obligation, you only have the right, and you don't have to exercise this right if you don't want to. But what exactly does this right to buy or sell the underlying asset at a certain price actually mean? Let me give you an example. I will start by giving you an example of a call option. Remember, a call option gives you the right to buy the underlying asset at a certain price. Ideally, you should write this down, as this is the core concept of options, and you will always have to know this. So let's say you buy a call option on the underlying asset XYZ. XYZ is just an example of a ticker symbol of a stock. So let's say XYZ is a stock, and that's the underlying asset for your call option. You buy one call option, and XYZ is currently trading at $100. This means that this call option that you bought gives you the right to buy XYZ at a certain price. And for the sake of this example, we'll just say that this certain price is $100. So by buying the call option, you get the right to buy XYZ at $100. Let's think about that for a second. What does this mean? If you have the right to buy XYZ at $100 and it's currently trading at $100, what do you want the underlying asset, so XYZ, to do? Well, you want it to go up. If XYZ's price increases to, let's say, $120, you still have the right to buy it at $100. So that means you can buy XYZ at $100 and sell it in the open market for $120. That's a $20 profit per share. In other words, buying call options is a bullish strategy. By buying them, you hope that the underlying asset's price will go up. Now let us go over the same example for a put option. This time the underlying asset is ABC. Once again, you buy one put option, and hopefully you still can remember, put options give you the right to sell the underlying asset at a certain price. In our example, ABC is currently trading at $45. For the sake of the example, once again, we'll just say that the certain price that you have the right to sell the underlying asset for is $45. So by buying this put option, you have the right to sell ABC at $45. What do you want the underlying assets price to do? To go down, of course. If ABC's price dropped down to $40 and you still would have the right to sell it at $45, that would be a 5-point profit per share for you. To recap, call options are a bullish strategy. They profit from increase in price, and put options are a bearish strategy. they profit from decreasing prices. Here are some important factors when buying options. First off, you need an underlying asset. In our two previous examples, the underlying assets were XYZ and ABC. Theoretically, any stock can be an underlying asset. However, not all stocks offer options. Most big name stocks do offer options though. You can definitely trade options on Apple, on Twitter, Microsoft, GE, Boeing, and lots of other stocks. You can also trade options on some ETFs, on indexes, commodities, futures, and many other assets as well. Another important aspect is what option do you want to buy? Do you want to buy a call option or a put option? Remember, there's a big difference between these options. Call options are bullish, put options are bearish. Call options give the owner the right to buy the underlying asset at a certain price, and put options give the owner the right to sell on the underlying asset at a certain price. This certain price is also referred to the strike price. So the right to buy at a certain price is also the right to buy at the strike price. Here in our previous example, the strike price for the call option was $100, as you had the right to buy XYZ at $100, and for the put option, the strike price was $45, because you had the right to sell ABC at $45. Furthermore, you also need an expiration date. Like I mentioned earlier, options don't go on forever. They have an expiration date. After a certain time, you lose this right to buy or to sell, depending on if you bought a call or a put option. But after some time, you lose this right. Just like having tickets to a concert that expire after the concert was held, options expire after the expiration date. But more on the expiration date later on. Here is a little more about strike prices of options. Often, you can choose between a wide variety of different strike prices. Sometimes stocks or other underlying assets have a strike price every dollar. Other times they only offer strike prices every $5, and sometimes the distance between each strike price is even greater. Let's get back to our previous example. Once again, you buy one call on XYZ, which is the underlying asset, and XYZ is still trading at $100. So, in other words, you buy the right to buy XYZ at the strike price. So what happens if we change this strike price? In our previous example, we said that $100 was the strike price. The strike price of $100 would mean that you have the right to buy XYZ at $100. A strike price of $95 would mean that you would be able to buy XYZ at $95. A strike price of $105 would mean that you could buy XYZ at $105. However, note that the strike price is a big part of the price of an option. So the option with the strike price of $95 will be much more expensive than the option with a strike price of $105. If this wouldn't be the case, you could make easy money. Let's say you would buy one call option on XYZ with a strike price of $95 for a few cents. This would mean that you could buy XYZ at $95 through the call option and then immediately sell it at $100, as that's what XYZ is trading at in the open market. As you can see, this would be a more or less risk-free opportunity, and these opportunities usually don't exist in the market. So this option with a strike price of $95 would be much more expensive. Also note, To make money on the option with the strike price of $105, XYZ's price actually has to increase and move up and beyond $105, because otherwise the strike price would be higher than the underlying trading price, and you don't want to buy a stock for more than it's actually worth. And for put options, it's exactly the other way around. We still have the underlying asset ABC. It's still trading for $45, and some potential strike prices could be $45, $40, $50, or even more ones. As you just noticed, strike prices can either be above, below, or at the underlying trading price. There are 3 different classifications for options with different strike prices. The first is OTM, out of the money. The next one is ATM, at the money. And the last one is ITM, also known as in the money. Let's start with the easiest one, ATM, at the money. ATM options, or at the money options, are those with the strike price at the underlying trading price. So if the underlying asset, in our example here, XYZ is trading at $100, then an at the money option is an option with the strike price of $100. I marked the at the money option with blue in this table. Out of the money options are different for call and put options. For call options, out of the money options are those that have a higher strike price than the underlying trading price. So if XYZ is trading at $100, out of the money options are options with a strike price of $101, $102, or $103. So once again, options with a higher strike price than the underlying asset's trading price are out of the money. At least that's the case for call options. For put options, it's actually the other way around. If the strike price is below the current underlying trading price, a put option is considered out of the money. In the money is obviously the other way around for both options. So call options are in the money if their strike price is below the current underlying trading price. Put options are in the money if their strike price is above the current trading price of the underlying asset. I also recommend writing this down, as once again this is a very important and essential trading concept. You will have to know this very often in the future. But don't worry, after some time you will get used to this and you won't have to think about it anymore. But no matter what strike price a call option has, all call options profit from increases in the underlying asset's price, and the opposite is the case for put options. No matter what strike a put option has, they will always profit from decreases in the underlying asset's price. Let's practice this in the money, at the money, out of the money concept with a few examples. As I just said, this is a very important concept, and therefore I want to present some examples so that you can learn it in a better way and remember it longer. So first off, in our first example, the underlying asset is still XYZ. XYZ is trading for $100. So is the put option with a strike price of 107 in the money, at the money, or out of the money? Think about this for a few seconds. So the put option with a strike price of 107 is in the money. Why? Because its strike price is above the underlying asset's trading price. Next up, the call option with a strike price of 107. Is it also in the money, or is it out of the money, or at the money? It's out of the money. Its strike price is above XYZ's trading price. Call options are out of the money if the strike price is above the current trading price of the underlying asset. And this is the case here. So what about the call option with a strike price of $100? This is at the money because its strike price is at the underlying trading price. Last but not least, what about the put option with a strike price of 98? That option is OTM, so out of the money. Put options are out of the money if their strike price is below the current trading price of the underlying asset. So, 4 more examples. This time the underlying asset is QRS. It's trading for $74. I'll go through these examples a little bit faster this time, so I won't waste too much time. The call option with a strike price of 76 is out of the money. Its strike price is above the trading price of the underlying asset. The call option with a strike price of 60 is in the money. Its strike price is below the current trading price of the underlying asset. A put option with a strike price of 80 is in the money as well, because its strike price is above the underlying asset's price. It's the other way around for put options than for call options. Lastly, the call option with a strike price of 74 is at the money, because its strike price is at the underlying trading price. Hopefully you got at least a few of these right. If not, don't worry, you can always rewatch this, or you will definitely learn this in the future if you stick with options. Next up, we have expiration dates. Options are decaying assets, so they aren't like stocks, you can't hold on to them forever, they decay with time. An option that has 50 days left until its expiration is better than an option that has 10 days left to its expiration. It's the same for options as for foods. Let's say you buy an apple that's very fresh. This apple will be better than a very old apple because it's also a decaying asset. So options have limited time, and after that time they're either worthless or they are worth something. Options can be traded in very different time frames. You can either choose expiration dates that are years out from now, or you can find some that only have a few days left until their expiration. There are different expiration cycles. You can trade weekly options, monthly options, quarterly options, or other options. Very long-term options that have expiration dates in more than a year from now, those options are considered LEAPs. L-E-A-P-S. Now let us talk about American versus European options. There are actually both American and European options. And this has absolutely nothing to do with the location of where these options are traded. It has only something to do with the exercising process of these options. When you use your right to buy or sell the underlying asset at the strike price, that's called exercising an option, or exercising your right to buy or sell. European options can only be exercised at expiration, so you can only buy or sell the underlying asset at the strike price at the expiration date for European options. American options, however, can be exercised whenever you want to. So they can be exercised 1 day before expiration, at expiration, or 1 year before expiration. Usually, American options are a little more common than European options. Now let us get into some standard contract sizes of options. One standard option contract controls 100 shares of the underlying asset. Let me give you an example to explain this better. You buy one XYZ call, so one call on XYZ. This gives you the right to buy 100 shares of XYZ at the strike price. So one option does not control one share, but 100 shares. And even though this example is an example of a call option, the same is the case for a put option. So one standard put option gives you the right to sell 100 shares of the underlying asset at the strike price, and one standard call option gives you the right to buy 100 shares of the underlying asset at the strike price. Often prices of options are quoted as if they only control one share. So often you can see that an option only costs $1, but that's the price if an option would only control one share. So normally you have to multiply this price by $100 to get the true price for one standard option contract. Buying versus selling options. Just like in stocks, you can either buy to open or sell to open an option position. Buying is also referred to as going long, and selling is also referred to as shorting. This is not only the case for options, but also for stock or other trading. If you long something, you buy it, and if you short something, you sell it to open. There's quite a big difference between buying to open or selling to open options. Like we said earlier, buying an option gives you the right to buy for call options or sell for put options the underlying asset at the strike price. So a long put is a bearish position. Bearish just means that you want the underlying asset's price to go down. And a long call is a bullish position, meaning that you want the underlying asset's price to go up. As a seller of a call option, you have the obligation to deliver the shares of the underlying asset at the strike price if the buyer of that option exercises his right to buy. As a seller of a put option, you have the obligation to accept the shares of the underlying asset at the strike price if the buyer of that option exercises his put option right. The key difference between buying and selling options is that you no longer have the right as an option seller, but the obligation to deliver or accept shares at the strike price. This does not mean that you will always have to deliver shares to call buyers or accept shares from put buyers. You only have to do this if a buyer of that exact option exercises his right, and this does not happen too often in the world of options trading. The process of having to deliver or accept shares of the underlying asset at a certain price is also known as assignment, but you will learn much more about assignment when you learn more about short selling options later down the road. You know that long put positions are bearish, however short put positions are bullish. A put option seller wants the underlying asset's price to go up so that the buyer of that option does not exercise his right. The opposite is the case for a call option seller. A call option buyer is bullish on the underlying asset. The call option seller is bearish on the asset. Now you know most of the options basics. You know about expiration dates, about standard contract sizes, the main difference between buying and selling options, you know about strike prices, underlying assets, and even more. So let me give you some examples, and once again, try to think for yourself before I reveal the solution here. So the underlying asset for the first example is EFG. EFG is trading at $235. Someone opens the following position: 1 long 230 call Joule 20. What does this mean? This means that someone bought one call contract. Remember, long is another term for buying. The strike price of that call option is 230, which is in the money because the strike price is below the underlying asset's trading price. And the expiration date is the 20th of July of that year. So 1 stands for the number of contracts, long for buy, 230 is the strike price, call is the option type, and Joule 20 stands for the expiration date. So this position gives you the right to buy 100 shares of EFG at $230 until the 20th of July. So this is an American style option because you can't only exercise your right at the expiration date. Ideally, this should make sense to you now. You have the right to buy shares of EFG because you bought a call option. It's 100 shares of EFG because you bought one contract, and one normal contract controls 100 shares of the underlying asset. You can buy the shares at 230 because that's the strike price, and you can only do this until the 20th of July because that's the expiration date. Now let's move on to the next example. This example has the underlying asset ABC. ABC is trading at $34 and the position is 5 long 40 put ZEP 21. What does that mean? Once again, the number in the beginning stands for the number of contracts. So 5 put contracts. Long is referring to buying. The strike price is 40, which is again in the money because put options are in the money when the strike price is above the underlying asset's trading price. And finally, the expiration date is the 21st September. Think about what this exactly means for a few seconds and then I'll reveal the solution. So this position gives you the right to sell 500 shares of ABC at $40 until the 21st of September of this year. So once again, this is an American style option. Let me explain why this is the case one more time. The right to sell comes from the put option, and 500 shares is because you bought 5 put contracts. Each contract controls 100 shares of ABC, and $40 is the strike price, and the 21st of September is the expiration date. So you can use your right until this date. Here's an example of a short option position. So this time the underlying asset is XYZ. XYZ is trading at $111. And the position is 20 short 111 put April 20. So you sell 20 put contracts because short is referring to selling. The strike price is 111, which is at the money because the strike price is at the underlying asset's trading price. And the expiration date is the 20th of April. This position gives you the obligation to buy 2,000 shares of XYZ at $111 if and only if the buyer of those options chooses to exercise his options before the 20th of April. Let me clarify everything once again. The obligation to buy comes from the sold put options. So a put option normally gives the buyer the right to sell the underlying asset at the strike price. However, if you sell a put option, you have the obligation to buy those shares of the underlying asset at the strike price. So it's 2,000 shares because it's 20 put contracts. Each one of those contracts controls 100 shares of stock, so 20 times 100 equals 2,000, and $111 is the strike price. But note that you only have to deliver these shares if the buyer of those options exercises his right. So if he does not exercise his right, you won't have to buy those shares. The last example is with the underlying asset QRS. QRS is trading at $364 for this example, and the position is 2 short 375 call Joule 20. 2 stands for the number of contracts, so 2 call contracts. Short means sell, and the strike price is 375, which would be out of the money, because call options are out of the money when their strike price is above the underlying asset's trading price, which is the case here. Lastly, the expiration date is the 20th of July. So this position would mean that you would have the obligation to sell 200 shares of QRS at $375 if, and once again, only if the buyer of those options chooses to exercise his options before the 20th of July. I don't think I have to go over all of these aspects separately once again. If you feel that you need that, then just rewatch the past 3 examples 1 or 2 times. There's absolutely nothing wrong with watching these things multiple times before you understand them completely. That's the beauty of recordings. Now I want to dive into some option chains with you. So what are option chains? Option chains basically are tables that display the most important options trading related information. The information that you can find displayed in the table on your screen right now is very typical for option chains. First off, you have to display the underlying asset, because that's very important. What's the underlying asset? Next up, what's the expiration date? Is there 1 day or 1 year, 1 month or 1 week or something in between until the option expires? That's obviously very important information that everyone has to look at before trading options. Next up, the strike price plays a big role. The strike price determines how expensive an option is, and also how far the underlying asset's price has to move so that you make money with an option. Next up, an option trader obviously wants to know what type of option it is. Is it a call option or is it a put option? And often there's displayed even more useful other information in option chains. Let me give you some examples of real-life option chains. First off, I want to show you a Nasdaq option chain. So as you can see up here, this option chain is for Apple. AAPL is the ticker symbol, and you can also see the ticker here. This is the underlying asset. Next up, you can see the option type here. Here are the call options on the left hand side, and the put options are on the right hand side. This is a very typical layout of an option chain. In the middle, this is also very typical, you can see the strike prices. Here's 130, 131, 132, and so on. So as you can see, these are dollar-wide strike prices. There's one strike price every dollar. This is also very common for heavily traded stocks like Apple. And here, up here, or also on the left-hand side, or below the puts, you can see the expiration date, which is March 31st, 2017. And up here you could theoretically change the expiration date. These yellow zones indicate the in the money zones. So these call options that are in this yellow zone are in the money, and the put options that are in the money are these ones down here. So from that information you can find out that Apple was trading at around 143 to 144 back then. Otherwise, you can also find some other useful information like the last traded price, the bid-ask price, the volume, the change of these options, and more. But that's not as important right now. Next up, I want to show you some option chains from the broker that I use. The broker platform that I use is called Tastyworks, and in my opinion they are great for options trading, but that's not important right now. I don't necessarily recommend that you open a broker account right now, as you're still in the beginning. Education is still more important right now, but I just want to show you some of their option chains. I'll just show you an option chain of Apple once again. And right here you can see the different expiration dates on the left hand side here. The 13th of July, the 20th of July, the 27th of July, up until the 19th of June in 2020. So this would be a leap option, a very long-term option that expires in a few years. In the middle you can see how many days there are left until expiration. So the nearest expiration date has only 1 day to go, and the furthest has 708 days to go, which is fairly long. Let's just go for one here in the middle. This one, August 17th, 2018. It has 36 days to go. And once again, here in the middle, you can see the strike prices. Apple is currently trading at right around $191. So the at the money option is $190. And $195 is also relatively at the money. It's near the underlying trading price. Once again, we have the put options on the right hand side and the call options on the left hand side. The strike prices are every $5. We have one 195, 200, 205, and so on. In this column we can see the ask price for each option. Here we can see the bid price for each option. The same goes for the put option. The first column is the bid price, the next the ask price, and this delta and volume figure, you can just ignore that. That's not important for now. So the call options that are in the money are these ones up here above the orange line, and the in the money put options are the ones below this orange line. So as you can see here at the bid or ask price, most of these options aren't too expensive. For example, an at the money option here, this one with the call option with the strike price of $195 only costs $3.50, so $3.50. That seems fairly cheap, right? Remember that one standard option contract controls 100 shares of the underlying asset. So if you have to actually multiply this price by 100 to get the actual price for one contract. So if you would want to buy this call option with a strike price of $195, you would have to pay $360 for one contract. So hopefully these two examples of an option chain gave you a good idea of what option chains are and how they can be used. Option chains show you what different options exist, and they show you the most important, essential options trading information that you need to trade options. Now let us get into trading options. You now know that you can exercise the right that an option gives you and thereby close the option position. However, you can also just trade options like you would trade stock. Stock positions are normally opened by buying and closed by selling, or the other way around. The same can be done with options. You can buy an option and later sell it without exercising it. So if you're not interested in the underlying asset, you can also just close the position for a profit or a loss depending on how the position went, instead of exercising your right or exercising your option. So option positions can be closed anytime before expiration, just like you would close a stock position. And here is an example trade. You buy an option at $1 and later on sell it for $1.50 for a 50-cent profit a few days later. So actually most options aren't exercised. Most option traders don't exercise their options but try to close their option positions for profits. With that out of the way, let's get into some questions. So now I'm going to present a quiz with multiple questions. Try to answer these questions yourself. You may pause the video when we get to it, but don't just let me present this. Try to think about it yourself. Doing this will improve the learning experience by a great extent. So let's get into the first question. XYZ is trading at $256. Which of the following options is in the money? Which is out of the money and which is at the money? A is the call option with the strike price of 256. B would be the put option with the strike price of 245. And C would be the call option with the strike price of 245. So which is in the money, which out of the money, which at the money? Okay, I'm going to reveal the solution now. Option A is at the money. Its strike price is at the underlying trading price and therefore it's at the money. Option B is out of the money because put options are out of the money if their strike price is below the underlying asset's trading price, which this is here. 256 is greater than 245. Last but not least, the call option with a strike price of 245 is in the money because its strike price is below the underlying trading price, and call options are in the money if that's the case. Now let us move on to question 2. ABC is trading at $12. By how much is the put 9 option out of the money? And if you haven't guessed by now, put 9 means the option with the strike price of 9. So by how much is that option out of the money? The answer is by $3. All you have to do is subtract 9 from 12 to get to this solution. So the difference between the underlying trading price and the strike price is by how much is out of the money here. Question 3 is, which of the following options would profit from a rise in the underlying price? A short call, B, a short put, C, a long call, D, a long put. Let me give you a hint. There's more than one correct solution for this question. The first solution is the short put. Long put positions profit from decreasing prices, so short put positions profit from increases in prices. The next correct solution is C, a long call. So long calls are bullish strategies. The fourth question is, what is not displayed on an option chain? A, type of option, if the option is a call or put option. B, the option's price. C, the strike price. D, the expiration date. Or E, the type of order, long or short, if you want to buy the option or sell the option. So the correct solution is E, the type of order. So even though option chains can be customized, you can't display the type of order because this depends on the individual options trader. If you, as an options trader, want to buy an option, you can do so. If you want to sell an option, you can also do so. But the option chain doesn't tell you what you should do, so it can't display if you should buy or sell an option. Hopefully this makes sense. The fifth question is, what is a European style option? A, an option traded in Europe. B, an option that only can be exercised at expiration. C, an option that always can be exercised. The correct solution is B, an option that only can be exercised at the expiration date. European style options can only be exercised on that date. So A would be wrong because that has nothing to do with the location, and C would actually be the description of an American style options, because American style options can be exercised before the expiration date as well. Now the next question is, does an option buyer have to exercise his option? The two possible answers are no or yes. So if you haven't listened, it's basically a 50-50 shot. The correct answer is no. He has the right but not the obligation. Option buyers don't have to exercise their right to buy or sell the underlying asset. They can also just close the position or let it expire worthless. Next up, what can the buyer of 3 XYZ put 50 option contracts do? A, sell 300 shares of XYZ at $50. B, buy 300 shares of XYZ at $50. C, sell 3 shares of XYZ at $50. D, buy 50 shares of XYZ at $3. The correct solution is A, sell 300 shares of XYZ at $50. So you bought 3 contracts. Each standard option contract controls 100 shares of the underlying asset. So that's why you can sell 300 shares. At $50 is because 50 is the strike price, and you bought a put option, that's why you can sell and not buy the shares at that strike price. The final question is, what are some key features of the following option? QRS put 110 Joule 20. So this time you should find an answer for A through D. You can't select one possible answer, but you have to find the underlying asset, the option type, the strike price, and the expiration date. So let's start with the underlying asset. The underlying asset is QRS. The option type is put option, and the strike price is 110. Last but not least, the expiration date is the 20th of July. So hopefully you got some of these questions right, and if not, once again, don't worry, you can always retake the quiz or rewatch this segment or rewatch the entire masterclass. Like I said earlier, there's nothing wrong with not understanding everything in the first go. Before we get into some final words, I just want to recap what you have learned in this masterclass. So about 1 hour ago, you probably knew almost nothing about options, and if I did my job right, you now have a stable foundation on which you can build a lot more of future trading knowledge. Everything that you've learned so far is extremely important. You will need all of this if you want to learn more about options. This is what everything is based upon. If you haven't understood something completely, don't skip ahead, don't move on, look at it again, maybe not now, but after I finish with this masterclass. But don't skip ahead if you haven't understood something completely. Don't move on to more advanced options concepts if you haven't completely understood all the basics. I know it may feel overwhelming right now because I presented a lot of content in a short amount of time, but rather go through things too often than the opposite. And if there's something that you don't completely understand, and even after rewatching this you can't understand it, please contact me. I would do my best to help you out. If you want to contact me, you can either leave a comment under any of my posts or articles or lessons or anywhere, or you can contact me directly per mail at luis@tradeoptionswithme.com. And never hesitate to contact me if you have trouble understanding something. So what exactly have you learned? Well, you have learned all the option basics. You have learned about different types of options, about call options, about put options, what these options are, how they work, and what rights you can get by buying them. Furthermore, you have learned about strike prices. You've learned about in-the-money options, at-the-money options, and out-of-the-money options, another very important concept. In addition to that, you've learned about expiration dates. You've also learned some differences between buying and selling options. And you've also learned how option chains are set up, how they work, how they look. Ideally, you should now be able to look at option chains and actually understand what's going on and what the different information on there actually means. But we aren't completely done with this masterclass quite yet. First off, I want to show you something. I have a little gift for you. Hopefully, this gift can help you on your journey. It's just a small thing that potentially can help you a lot with your trading education. So the gift is my options trading terminology handbook. In this handbook, I listed all of the options trading terms or general trading terms that seem complicated to beginner traders, but actually aren't that complicated at all. I listed all of those terms and added explanations to them. So it's basically a small trading glossary. In my opinion, this really can help traders with their trading education. While taking someone's course or going through a masterclass like this, or while reading articles or books or whatever else, as soon as you come across an unknown or seemingly complicated trading term, you can just grab this book or handbook and look up that word. Hopefully it will be in there and there will be a short but easy explanation of that word. I will send you a PDF after this masterclass so you can get your own copy. But that's enough about this free gift that I'll send you after this masterclass. Now let's move on to what's next, or actually what's not next. Before I present to you what's next, I just want to talk about what's not next. With this, I want to prepare you for the world of trading. I want to show you what you should expect, what will happen next, and generally what mindset you should have when trading or actually when learning to trade. So what's not next? Well, next is not profitable trading, or actually trading in general. You shouldn't go out there after this masterclass and risk any of your hard-earned money. You have the foundation now, but that's not enough. You're not at the top yet. You shouldn't go out and actually trade and risk money. You won't make tons of money trading tomorrow, next week, next month, or probably even next year. You can't and won't learn to trade within a few days or probably even weeks. This is not only relevant for options, but for all trading forms. Learning to trade profitably takes time. That's fine, but you shouldn't have the wrong expectations. Don't risk your hard-earned money before you completely know what you're actually doing. If there's something, just a tiny thing, that you don't understand yet, then don't risk your money. Educate yourself and learn what that thing is. In my opinion, the key to success in trading is educating yourself. The preparation before you go out and trade is what defines your trading results. Write this down. Trading is the last piece of the puzzle. Trading itself doesn't take a long time. All that trading is you set up an order and pull the trigger. But the work that goes into the preparation, the education, the research, the analysis and more, that's the part that takes a long time. But sadly, that's the part that most people skip. And that's why I think 90% of traders fail. And I'm not saying this to discourage you. If I'm doing that, then sorry. But I'm saying this to develop the right mindset in you. About 90% of traders fail. If you want to become part of that 10% group that don't fail, you have to put in the work. So don't have the wrong expectation. Trading is not a get-rich-quick scheme. If you don't believe me, you have the wrong approach and probably will fail, like 90% of most other traders. Just think about trading this way. If you could learn to trade profitably within 1 day, 2 days, or 2 weeks, or even a few months, why the heck wouldn't everyone be doing it? If it would be that easy, why wouldn't everyone be doing it? Well, the answer is, it's not that easy. It just isn't. Success, not only trading success, but success in general, requires hard work. And if you're not willing to put in the work, then there's no point in even trying. So now that you know what's not next, what is next? Next is more education, more preparation, more studying, research, practice, and more of that kind of stuff. I will send you some homework so that you can prepare yourself even better. Like I said earlier, you now have the foundation. This is very powerful. However, you're not at those top floors yet. You can't build a skyscraper in a few days. It takes time, and that's totally okay. Just build one floor at a time, take one step at a time, and prepare yourself. If you don't feel that your foundation is strong enough, that's okay. It never hurts to strengthen your foundation. Either rewatch this, or go take some other courses if you don't like this, or do whatever it takes to strengthen that foundation. I can't emphasize the importance of this foundation of the option basics often enough. Everything that you're going to learn in the future requires you to know this. If you don't know the basics, then you won't understand the more advanced concepts either. You now started the journey to becoming a profitable trader. Now stay on it. Like I said earlier, there are many different ways to make money in the stock market. But it's important that you find one, stick to it, and actually commit. You shouldn't jump around between different ways. You shouldn't go into options one day, the next day you try some stock day trading, on the next day you think, let's try Forex, on the day after that you jump into some cryptocurrencies, or whatever. It doesn't work that way. You won't find success if you do that. Find one thing, commit to it and learn. Later on you can always choose another path, but start by actually going through with one. Too many people try out something for a few days or weeks or even months, and then they say, well, it doesn't work. That's the totally wrong approach. If you do that, if you try something for 2 days, of course it won't work. What do you expect? It's not a get-rich-quick scheme. Like I said, if it would be easy, everyone would be doing it. But just remember, it's a marathon, not a sprint. You have a long road ahead of yourself. It won't always be easy, but believe me, if you don't get distracted and stay on that journey, it will be well worth it. There's nothing wrong with holding a break, feeling exhausted, or being tired, but it's very important that you don't stray away from your path. This is just the beginning. You shouldn't stop building a house just after the foundation. Don't slack on your education. It's the most important part. After you prepared yourself enough, after you put in the work, the trading will be easy. Here is an analogy. Compare trading to professional sports. People watch tons of sports on TV. But when you watch someone take part in the Olympics, all you see is the end result. You have no idea about all the work, all the hours that went into the preparation for that competition. The same is the case in the world of trading. Most people just hear of these very profitable traders and their amazing track records, their fancy lifestyle, and in general their amazing life. But no one hears about the hundreds or even thousands of hours that went into the making of that trader. I really hope you get my point. Don't rush trading. Take the time it takes for you. Even if you only have an hour per day or only half an hour per day, that's fine. Just use that hour per day to educate yourself, to prepare yourself, and to actually study the markets and education. Otherwise, frankly, you won't be successful. Hopefully, I and other people can help you on your journey, but it's only you that actually can take the journey. No one else can take this journey for you. You can't cheat your way to the top. There aren't any get-rich-quick schemes that actually work. All of that's a scam, and if anyone tries to tell you otherwise, don't believe them. Thanks so much for watching. I truly hope that you learned tons of new, important, valuable lessons in this masterclass. Not only lessons about options trading and the technical details and the basics of trading, but also some important psychological lessons about success in trading and general about success in life. Make sure to check your email inbox for the gift that I'll send you and for some potential homework. And once again, if you have any questions regarding this masterclass or trading or anything else, please contact me. My mail is louis@tradeoptionswithme.com. And remember, you have a long journey ahead of yourself. Good luck.